Now on the CNBC Newsline is BlackRock's Rieder. He joins us exclusively. It's good to talk to you. Thank you so much for calling in. We obviously have highlighted, Rick, your post on social media within the last hour. You've heard a lot of the conversation, and I'm sure you've spoken with many people today about what the Fed should do, if anything. You make the argument that it's time. This is what you say. The need for the Fed to move the Fed funds rate closer to 4% to 4.5% sooner rather than later. Are you making the argument that the Fed needs to move intermeeting?
So no, not necessarily. I mean, by the way, the markets are pricing in that they're moving well through that certainly over the next year and a half. Listen, I think the funds rate is priced wrong for if you have inflation. I mean, look at today, the inflation break-even market, 5-year inflation traded down to 175. It's back to 192. If you got inflation, the markets expect inflation well below 2%. The 3-month, 6-month moving average of inflation is right at 2, just above 2, and you have an economy moderating. 5 3/8 off of 2% inflation is not the right number when you have clearly pressure on lower income. You see that on all the earnings numbers that I think you got to move. Do they have to panic and do intermeeting? No, but I think some communication to the effect of the markets are, what the markets are pricing in, they are anticipating moving somewhat. I think evolving that communication would be helpful.
But if you suggest that the Fed is already way too restrictive, should they have moved last week? Are they already too late?
I think the Fed has the ability. I think the price is wrong in terms of where interest rates are. Should they have moved last week? Were they set up to move for last week? They really didn't set up communication-wise to move in July. But should they set up the communication such that in a pragmatic way, without panic, that interest rates need to come down or should come down, and they're respectful of the fact that the dual mandate is very much in play, i.e., unemployment or employment is you're starting to see real slack, and with slack building and inflation down to target, then you've got to move the funds rate down. So I think they can set up for it, and I think the communication, they could have pragmatic communication that they are respectful of a change in where we are in terms of the economy. Listen, I'll say one thing, and I heard bits and pieces of what was on before me. I think the economy's in fine shape. I think it's slowing. And I think it's slowing, and you're building slack, and you clearly have a durable nature to inflation coming down, so the Fed should move the rate to where it's appropriate.
But what are you seeing or hearing on your end from those you're either talking to today or of what you're looking at in terms of the unraveling here of this carry trade?
So the first thing, coming in this morning and watching Japan move like it did, that is not a normal condition to see equities in Japan. Now, some of that I think is emblematic of there's a lot of crowded positions. There's a lot of people who have piled in the same trades, Japan being an example thereof. So you're witnessing, and certainly over the last week or so, a lot of these crowded positions, almost on cue, the crowded positions have come under some pressure. Some of it, I think, is just a natural. In the month of August, liquidity is not great. You've got crowding, and so you're getting some rebalance relative to that. There's some, by the way, part of what makes this an interesting market is there's some stuff to do. There's some things to trade because the markets are overshooting in a bunch of places.
Such as where? Says the global CIO of BlackRock.
I had a feeling you may ask that. Listen, I think the front end of the U.S. rates curve has moved to an extraordinary amount with a Fed that certainly hasn't chronicled their movement anywhere close to that. That is signaling clearly in terms of where that market is signaling a recession. I think the inflation market has come down dramatically, and if you look at the move today, you're talking about where do we go? You got 25, almost 30 basis point move in inflation today, and now we've rebounded. The front end of the yield curve, you look at the move, what was it, over 30 basis points today. There are opportunities across these markets where you're seeing some extreme moves and we're taking advantage of some. By the way, I would say the same thing on the equity market. Some of the names that have reported good earnings and buying back their stock that are down mid to high single digits, there's some opportunities in some of those as well.
Interesting. Do you worry about what isn't today that could be tomorrow, so to speak? Credit is acting reasonably well in the face of all of this. Do you worry about that changing? How are you thinking about that?
So there's a couple things. I mean, first of all, credit is in the best fundamental shape I've ever seen it, probably in my entire career. They've termed their debt out. The cash flow coverage is still good. I mean, the high yield market is not junk anymore. It is in really good shape in terms of credit quality, much more in the way of double Bs, a lot of high yield that's moving up into investment grade. So I think credit's holding up well. Part of what you described, and we did some tactical positioning and reducing some of an investment-grade credit because you're going to get a lot of supply at lower rates. Investment-grade credit I don't think is very interesting. I think the high-yield market would still get you a lot of yield with technicals that are really good and fundamentals that are superb. I don't think it's wrong that particularly the high-yield market holds in well.